Welcome to Your Money, Your Retirement, Your Life, the show that helps you make the most of all three. Hosted by Drew Pelton of Drew Pelton Investment Services, where the focus is income first, growth second, and your goals always.
The greatest fear that retirees have, according to recent studies, is the fear of running out of money, the fear of not having enough money during your retirement, at the end of your retirement. The fear of having more life than money. And with all the medical advancements, there's a good chance you might be living longer. The question always with respect to retirement investing is how to make sure that your money is going to be there for you in the future. Tell me, is that how you think or feel? Because it is how the recent studies are showing people are thinking and what they're talking about. Retirees are afraid of running out of money and not having enough money in their latter years. Today, I'm going to be talking about retirement investing issues and traps. You're listening to Your Money, Your Retirement, and Your Life. Your money, your retirement, your life. I'm your host, Drew Pelton. Thanks for being with me today. Hopefully this makes sense. Well, let's just cut to the chase. What are some of the biggest issues that people face in retirement? Number one, taxes. And when I say number one, it isn't necessarily the biggest issue for you. I'm just saying it's on my list as number one. Number one, taxes. Number two, inflation. Number three, poor performance in your portfolio. Along with number three and poor performance in your portfolio, some subgroups or things to talk about would be not enough interest because of accounts that are supposed to be safe, but they're not giving you the return. I mean, let's say that you think you can get 3 or 4% still in a money market or a CD. What if inflation is at 3%? What if you have to pay taxes on that money because it's not tax-deferred money as in a qualified account? Where are you going? You can't get ahead at being flat. You can't get ahead at only 1% interest to make a point. There are retirement investing issues and traps you must know about. Why do you need to know about them? You need to know about them so that you do good and great for you. You have to make good and great decisions for you. Two of the biggest things that I find is a problem with people making decisions in and about their retirement investing is they are either frozen by fear or they are plagued by familiarity. Those two issues are pervasive. And that is partially why the book that I'm writing for the last 400 years, I've written the core framework of the book. I've written the guts of the book. And much of it is, if you're a regular listener, it has a lot of the content that I provide on my radio show and podcast here. But back to the facts of why did I name the book Your Money, Your Retirement, Your Life, is because my observation over the many years of assisting retirees is that too many people get stuck. They get frozen by fear. By fear of what? Fear of what to do. Fear of I can't do anything because the stockbroker said don't do anything. There is certainly something about buy and hold, but buy and hold doesn't always work if you're not in the right investments or if you're just simply stuck in low returning bank accounts or poor performing annuities, you have to know where you are. So rule number one, don't be frozen. When I say rule number one, there's about 100 rule number ones, which means that they're all important. But in this case and in this point, I'm trying to say that rule number one, for the sake of making smart decisions and for the sake of motivation, is do not be frozen. So understand that's the solution. I mean, it's really, how do you become not fearful? Be not fearful. In the Bible, it says many, many times, hundreds of times, literally, fear not. Fear is one of the biggest things that plague people in life generally, and it's a big problem. Just do it. Do it now. These are some common statements that we know in this world today. Just do it, or do it now. I mean, these are critically important things. Don't be frozen. Frozen for any reason, fear or general procrastination, is not the answer for resurrecting your portfolio or making your portfolio that which it needs to be. So freeze not is the good way to think about it. Be frozen not. Number two, familiarity. Familiarity can be a problem. And too often I find that people are familiar with an advisor, a brokerage firm, a way of doing something, all mutual funds, or you've been doing annuities for many years and you just become familiar, and familiarity keeps you sometimes stuck where you're not looking at what the situation is. A key thing in retirement investing success is for you to discern. The biggest problem that I see that investors have, besides inflation, besides taxes, besides poor performance, is simply oneself. And you don't want to be in the way of your success. It's so easy, I believe, for people to think here in Baton Rouge, go LSU, go LSU. We love our teams, unquestionably. And I see sometimes some people who I know are the biggest LSU enthusiasts and fans, and then they can talk about it and they can talk about LSU, but when it comes to their own money and their own finances, they are what? They're either frozen or familiarity is plaguing them where they're not doing anything, which effectively gets back to frozen. In a sense, I could say there's two primary ways of being frozen. One is by fear, and the other is by familiarity. So today, as I am sharing this, I hope you are getting some good and great insight, because the fact is that too many people are either operating in a fashion where they're trying to be safe with too low returns, or they're taking on too much risk. So what do you have to do? You have to find the right balance. Balance, balance, balance. Balance in your approach and balance in your investment strategy so that it gets the job done for not just today, but for the many years ahead. Today I'm talking about retirement investing issues and traps. And you are listening to Your Money, Your Retirement, Your Life. I'm your host, Drew Pelton. Thanks for being with me. That's what we're talking about each and every week. It is your money, it is your retirement, and it is your life. Right? Of course. How could you say anything else? You have money, you have a retirement, and you have a life. And you need to understand each and every one of those components, and in a sense it's all one, but when you start to think about it all, when you get your money right, you can have a better retirement. When you have a better retirement, you can have a better life. Why did I come up with that topic? Is because not enough people, I find, truly embrace this sentiment where they make good and great decisions for themselves, and then they, as I was talking about in the last segment, they get stuck and they get frozen. They're frozen with fear, or they're frozen with familiarity. What's fear? Fear is the fear of not understanding, the fear of the unknown, the fear of familiarity of, well, I'm used to doing this. I know my advisor. I know the name of the organization that I work with. So therefore, I must be okay. My guy's a good guy. I like him, or the guy may be a gal. I like my guy or gal. Everything must be good. That's what I call familiarity. Too often, I have seen that fear and familiarity get in people's way, and people get frozen, and their frozenness is the problem. They are the biggest problem, and these are two of the biggest areas. And if this might be you, I'd suggest you might want to give us a call on 225-831-1394. 225-831-1394. That's our office line here in Baton Rouge, and I would suggest you give us a call and talk to us about how perhaps you might get unfrozen, and how you might be unfrozen by either fear and or by familiarity, because it is your money, your retirement, and your life. So let's talk about some risks that people are facing and will face inevitably in retirement. And these risks that I'm calling issues and traps are things that, if not addressed and dealt with and overcome, you need to overcome these issues. If you don't overcome them, you're going to find yourself going backwards. So certainly there's the inevitable taxes. When you have qualified money or retirement monies that you have to take out at a certain age, either in today's world, if you haven't started taking them out, it's age 73. Some of you who are older started taking them out as early as 70 and a half, age 70 and a half, or you may have for a year or so been taking them out at age 72. Now it's age 73 for those that haven't started. Those that are younger, that you have about 10 more years to go, it's going to be age 75. But the bottom line is when you take money out of a qualified account, you have to pay taxes on it. Or even if you're not taking money out of a non-qualified or after-tax account, you are going to pay taxes on the dividends and the interest, assuming it's not a municipal bond, as an example, or a tax-deferred annuity, because those are two examples of tax-deferred growth in investments. The bottom line is taxes have a serious impact on retirees in retirement. It reduces your portfolio to some degree. So how do you overcome that? That's part of the whole thing about solutions. How do we overcome taxes? How do we overcome inflation? They generally, over the last 40, 50 years, is easily seen at 3%. Many say it's 3.6 to 3.8% right now. And we'll have to see what it is, but if history repeats itself, one should easily factor in 3% over time to make sure you are keeping up with your purchasing power. The other big problem, other than taxes, inflation, are low returns. Returns that are not overcoming inflation, that are not overcoming taxes. Let's just say that you think you're doing well because you got a 3% return in a money market, as an example. Maybe you got 4%. Remember, interest rates are coming down right here as I give in this show, and this is October 2025, and the Feds are talking about continuing to lower the interest rates. Okay, let's look at an example of someone getting 3 to 4% perhaps in a money market. And those interest rates are going to be coming down as we hear the Feds talking about lowering the rates. They recently just lowered the rates only 1/4%. But if we look at an example of you have 3% and let's say that inflation is 3%, well, you're down to zero. Let's say you make 4% on your investment and inflation is 3%. And if you have to pay tax on the interest on the 4% and that costs you 1%, you're in both of these cases, or in many situations like this, you are at zero. And this is not how to get ahead when you're taking money out of your investments. Another factor, another issue, another trap is not understanding or planning for market losses, and understanding that you might have to take income from your investments, where you need to take income from income to not invade principal, because this is another major issue. In the long run, another issue, meaning when I say the long run, later in life, it could be the cost of long-term care. A few other things I want you to think about. Salesmen masked, like with a mask on, like Mardi Gras, salesmen masked as financial advisors. Salesmen masked as financial advisors selling poor performance investments. Salesmen masked as financial advisors selling poor performing assets. This is huge, where you may have bought something, bought an investment, bought something that sounds good, and where a salesman is promising something and it really is not performing. That's a big problem that I find that retirees have. Another is financial advisors who simply do not know how to manage money moving forward. And some of that has to do with annuities. Some of you think that if you buy an annuity, that's it. You don't need to talk to anybody. It's set it, let it, leave it. And that's not the case. I've seen so many egregious situations with the particular annuities that people invest in, as well as how they are poorly managed along the way. And if in any of these situations, if you need some help and you want to talk to me, give me a call on 225-831-1394, and I'm happy to talk to you about that. Okay, so what do you do? Well, a big thing when I say what do you do to overcome these issues of taxes, inflation, low returns, market losses, cost of long-term care, salesmen masked as financial advisors selling poor performing assets, financial advisors who do not know how to manage money moving forward, and they're hard to get a hold of, particularly if you don't have $1 million to $2 million, because that's a big experience that people have. And that's another thing I would say, if you're getting no attention because you realize you don't have $1 million and your guy or gal is basically running for the hills after they quote unquote sold you something or got your money, that's another reason why you probably need to talk to a true professional with integrity. I happen to know one. I recommend him highly. It's yours truly, Drew Pelton. So give us a call on 225-831-1394. We'd be happy to talk to you. I have to say, one thing we don't do is judge our clients by way of how much money they have. If you are truly, if an advisor is truly in the investment business for the right reasons, I believe they will work with anyone who has some assets, who has some money that needs to be invested, and they will treat that investor, they will treat that retiree with the same respect as the person, the investor that has a lot of money, 7 figures, $1, $2, $3, $4, $5 million. Not a lot of people do have those kinds of portfolios. Now, we work with people at all ranges. And certainly we work with very high net worth individuals. And for those that don't have much money, you can be assured that if you don't have much money, that will give you the same experience and knowledge and background that we have with respect to working with high net worth individuals as we will with you. And that's just how we work. And that's what you want. You want to make sure you're truly working with a dedicated professional who has that kind of commitment. So what are some of the solutions that you need to be thinking about? Well, number one, you want to make sure you have enough of a balanced portfolio where you're not taking too much risk, but you are balancing out the risk with getting high returns. Because if you go too safe with too low returns, or you go too risky to get high returns and you don't have the balance, you may find yourself facing problems that I've been discussing here this morning. So what are things that you can do? Well, one thing is to focus on investing for high yields, high dividends. Another is to get the investments you need for higher growth in markets that can be over time in the 7 to 9 to even 10% range, but you just have to know that over time there's going to be some ups and downs. So you have to balance out your safe money, your protected money, with your unsafe, unprotected money. It's important to understand the balance, and it's important to understand that you're going to get enough income so that you can get income from income where you're not invading principal. You need this triple advantage. You need this advantage of preservation and stability, number one. You need growth where you have minimal risk and volatility, where you're not taking deep dives before you come back up. That's number two, which is moderate growth, intelligent growth, or growth with minimal risk and volatility. And income from your investments, where you can get income from income, that's number three. So stability, one. Growth, two. Income, three. You have to have that balance. If you don't have the balance, you could find yourself going behind. Again, taxes, inflation, low returns are the top three, generally speaking. And then you start adding in things like cost of long-term care and advisors that are causing problems because they're not everything you thought they're going to be. So you need and want to make sure that you have your house in order. And you want to have your investment house in order. And I want to say here, and today I'm not talking about it, and I'll cover on another show matters about estate planning, but you want to have both your investment house in order and your estate planning house in order. So let me just say about estate planning, make sure that you don't think that estate planning is just for the rich and famous, because that's not the case. If you have any assets whatsoever, if you own a home, if you have any assets that you've invested in retirement plans, etc., you want to have an estate plan with all the documents, a will, a trust, or trusts, plural, powers of attorney, as in power of attorney for health care and for financial matters, and a living will or a medical directive. These are key documents, and you want to work with an estate planning specialist. We can help you in that area too. But the bottom line is you always want to have your investment house in order, and you want to have your estate planning house in order, and they need to be integrated. You are listening to, as I said, Your Money, Your Retirement, Your Life. I'm your host, Drew Pelton, and today I'm talking about investing issues and traps people have in retirement. Some of those, as I've mentioned earlier in the show, are taxes, inflation, poor performance, low returns, risk, volatility. These are issues that can be major problems along the way, year by year. However, they can be a very big issue and problem later in life, and that can be the cost of long-term care. The other thing can be you yourself. I was talking earlier about the problem of frozen and being frozen with fear or frozen with familiarity with people and advisory firms you've been working with when it's time to make a change, when the offerings of the advisor and the firms are not necessarily getting the job done. As an investor, you really need to and want to assess where you are on a regular basis. It's like healthcare, it's like your body, it's like medical care. It's the simple get an annual checkup at least. And I would say at most every 2 years. And you don't have to go back to the same doctor. Go where you can get the right answers. So let's talk about some of the things here with respect to taxes. So today I'm not going to drill down deep on any particular thing, but let's just talk about taxes. So what would be something you could do to minimize taxes in retirement? Well, one thing you could do with respect to RMDs or required minimum distributions is you could use QCDs or qualified charitable distributions to reduce your RMD taxes. What do I mean by RMD taxes? Your required minimum distributions the government requires you to take. And remember, if you don't take them, it's a 25% penalty plus the taxes. So if you send some of your required minimum distributions or even all, most people I find don't do it all, but if you use any of your required minimum distributions to go directly from the institution that's holding your money, your qualified monies, your retirement plans, and that institution sends it directly to the 501c3 organization, then you are going to be able to eliminate taxes on that amount you send to the charity. So in today's world where you typically most people are using the standard deduction, and I know some of you may be itemizing your deductions, but the standard deduction is so high these days that that's what most people use. And a lot of people who may not be doing that much with charitable giving or giving to your church, you may not have the advantage with that standard deduction being so high to get a tax advantage. Well, the thing with a QCD or qualified charitable distribution is you are actually able to take a top line deduction where you are going to minimize your taxable income. So that's a big key thing, particularly if you're charitably inclined. A couple of other things you can do is you can do strategic, and I suggest strategic Roth conversions where you are making intelligent, wise decisions on an annual basis as to how much you may want to convert to a Roth so that you put your taxable pre-tax retirement savings into a Roth account where you do not have to take any distributions, particularly if you don't need the income. And if you do take any money out of a Roth, it is not taxable. So Roth conversions are another good tax strategy savings. For non-qualified monies, tax advantages could be the utilization of municipal bonds. It could be the utilization of annuities. And let me say, whatever I say here on this show is not advice for you to just go do it, because not all municipal bonds are alike. Not all annuities are alike. And they can be, in both cases, complex in terms of the decision making and what's good and right invest for you, the investor. But because of the inherent tax advantage of those investments, you would be able to minimize your taxes because of the tax deferred growth of an annuity or the municipal bond tax advantages with respect to the interest. So that is very, very key, or these are some of the very key things with respect to tax savings. There are other approaches and strategies, but you need to work with somebody that understands these matters. With respect to inflation, I believe that's primarily a factor of you've got to get decent returns as in performance in assets that at least beat inflation, at least get ahead of the taxes you're going to pay. And if you don't average in your total return somewhere between 7 to 8 or 8 to 10% over time, you may find easily you're going backwards. If, as I mentioned earlier in the show, let's say that you get 4% even today in a money market, or just under 4%, depending on what institution you're working with. If inflation is 3%, and it could be higher, but if it's 3%, and if you're paying taxes on the interest on that 4%, let's call that 25%, 25% of 4% is 1%. Well, all you have to do is say 1% in taxes, 3% in inflation, and where are you? Zero. Zero is not how to get ahead of the game. And then when you are in retirement and you need to take money out of any investments, this is how you go backwards. This is a problem. This is a problem for so many seniors that don't understand all of these moving parts and the issues and the traps that people get caught up in. Some of the traps are the trap of working with a particular firm just because of the name, or buying a particular investment because of the name, or working with a particular advisor just because somebody else is doing it, where there isn't true discernment about the performance. Do you really think that LSU Athletics is going to just simply go forth when the players on the team are nice players and the coach is a nice person? I don't think so. You know so. Anybody in Baton Rouge knows that that is not the case, or I should say anybody in Louisiana. Everybody knows that LSU Athletics is all about, when I say LSU Athletics, I mean the LSU athletic department that's running a business, and that business is the business of winning. It's about winning. That's why I am talking about the importance of successful retirement investing. And successful retirement investing has to do with overcoming the issues and the traps that people get caught up in. And I am naming them today. So what are you going to do? Give us a call on 225-831-1394, and I'm happy to take a look at what you're doing and what the pitfalls may be, what the issues are, and what the traps are for falling into problems in the future. Remember, it's your money. It's your retirement, and it's your life. Get it right for you, no matter at what level you're at, no matter how much money you have, no matter how smart you think you are. You want to coach, you want to guide, you want to lead. Remember, only 84% of people in America have a formal financial plan. You may think you do, but most people don't. And I want to say one other thing. Only 5% of people have long-term care insurance. That's not a pitch for you having long-term care insurance, but it normally suggests that many people are exposed to the high probability of the cost of long-term care in the future. All right, today we are talking about retirement investing issues, problems and traps, and we're talking about solutions that you need to know about to get the job done. Let's talk about a couple of overriding problems. Biggest single problem that investors have is the investor themselves. Thus saith Warren Buffett. So don't just pick on Drew Pelton, because I know if you're listening in on a regular basis, I certainly have a reputation of calling it like it is. But don't you want somebody that calls it like it is? Do you want fluff talk, or do you want to have it called just like it is? If a coach is on the sidelines, whatever the sidelines is, football or basketball or soccer or whatever the sport is, don't you want a coach that calls it like it is? We all love a pat on the back, and we all love encouragement, and that's, always good. We like love. We all like those good feelings. But we all need a coach that can call it like it is. Why? So we can have corrective courses of action, or a corrective course of action in whatever we're doing that might be a problem. But yes, Mr. Warren Buffett himself says the single biggest problem in retirement investing is the investor themselves. Why is that? Many people lack the discipline to stay the course. Many people react when markets drop. And sometimes I have to say I understand that, particularly if you were too highly invested in the market. There's a way to create a balance. And when you create a balance in your investment portfolio, however that is, with a variety of assets that work for you, you may be able to stay the course a lot better. But you have to have the discipline. And that is a key thing in successful retirement investing. You want to have the discipline. You want to have a mindset for the long term. You want to have stable thinking. Well, that's easier to do when you have a solid plan in place that's going to go the distance, that's balanced for the considerations of market volatility, where it's balanced for the fact that you may have certain aspects of your portfolio that have lesser returns than others. And at the end of the day, there needs to be this triple advantage of preservation, growth, and income. And if you don't have the balance, at any given moment, you might run scared, or you may do more than run scared. You might make wrong decisions. Time normally is the friend of a good business. And if you make smart decisions where you choose sound businesses for the future, you're going to be able to allow time to be your friend in business when you are investing in markets. But what is the balance between cash, and when I say cash, whether it's U.S. Treasuries, money markets, CDs, perhaps fixed index annuities, being in the stock market, and bond-like instruments? What's right for you? It takes not a salesman. It takes not somebody selling exotic investments. It takes a balance, and it takes the approach of an advisor who is looking to do and help their investors with planning. And it takes you, the investor, wanting to do planning as opposed to buying only or transactional types of approaches. Generally speaking, a process and a plan works better than transactions and product buying and investment buying, because often what comes with product buying and investment buying is wrong decision making that might come from rash decisions or emotional decisions. A key way to invest in retirement is to use more logic and more discernment than emotions. One of the biggest problems retirees have in investing is the problem of emotions, the problem of reacting, the problem of getting nervous and having fear, the problem of truly not understanding where they are, what's going on, how the investments work. And when you talk about successful retirement investing, when you want successful retirement investing, you've got to have a balance and you've got to have an approach that is sound, an approach that is balanced for you, that is customized, that meets your goals, that meets your objectives. It's the only way to go the long term. Because as soon as you start reacting and selling assets when it's not time to sell them, and you start doing the things that are not successful, which is buying high and selling low, right? Everybody knows that. It's fundamental 101. What you should be doing is looking for good opportunities where you're buying low, as in the low price of the stock, as an example, and you're selling high when it's time to sell. And in the long run, what you need along the way is when you need income, you need an income first approach, balancing out the preservation of your principal. And if your objective is more growth first, then you should still have the balance of capital appreciation and income. It gets down to balance. If what you're hearing is resonating with you and you realize you may have the problems of taxes, inflation, and low returns or not adequate returns that are going to get you in trouble, or you don't understand how you're going to be able to pay for long-term care in the future, which is a 70% chance everybody's going to have some long-term care cost, then you can give us a call on 225-831-1394. I'm happy to talk to you and set up a meeting, or just talk to you on the phone or a Zoom meeting, whatever works for you. But I'd suggest that you focus in on your portfolio in a way how a champion would focus in when they're playing sports. Any champion in sports is going to be focused. I've been watching a fair amount of baseball. I like to watch baseball, particularly at this time of year when it's getting towards the World Series. And I enjoy looking at the faces of these baseball players that have a serious, focused look. And you know that serious, focused look is about winning. It's a champion look. It's a look of seriousness to get the job done. I ask you, the investor, are you having that serious look, that serious focus, that serious mindset about your money? Always remember, always embrace strongly, it's your money, your retirement, and your life. And you want to get it good and right for you. You need to have a sound portfolio so you can have the comfort and the confidence to do the things you want to do in retirement. What does it take? It takes money. And what kind of money does it take? It takes income. It takes income from solid investments. It's smart when you can get income from income. It's smart to get continual growth to keep ahead of inflation and taxes. It's smart to have preservation and stability along the way. If you have any questions about anything I'm sharing on the show, please either give us a call on 225-831-1394 and let us know what that question is, and we'll set up a time to talk to you. Or if you would like to email me at drew@drewpelton.com, I'm happy to answer any question that you have. Or if you'd like to have me share your question and answer, let me know that on the show. I'm happy to do that also. All right. Thank you for listening in. It's always good and smart that you're tuning in to good advice, to advice that can help you win the day. It's all about you. It's all about your money, your retirement, and your life. All right. Have a good and great rest of your day. Be blessed. Be with me each and every weekend, and I'll look forward to being with you then. Thank you.